we're about to do another video for the day. And this video is the difference between trading and investing. So my brief take on this before we get into the video is not everybody can be a trader, but everybody can be an investor. And the reason why I say that is trading is difficult, especially when you start using leverage and you start trading multiple asset classes like Forex, futures, bonds, let's say crypto. And when you start using leverage on these things, it can be a little bit trickier because you're going to have a stop, a definite way for entry, and then also a target. You can't just buy and hold, a currency or a commodity. Now you can do a commodity. You can buy and hold a commodity. But when you're trading with leverage, you start dealing with a little bit trickier situation when you're trying to trade with leverage. So even crypto you can buy and hold. But with like Forex, futures, unless you have like a really solid like reason for getting in fundamentally, and then you find a reason to get into it technically, I just wouldn't recommend it. But as an investor, you can invest into a business or a cryptocurrency or a commodity based business, or even just a commodity if you think it's going to go crazy in price over time. So yeah, we'll just get into the difference between both, and I'll give you my opinion on them.
This video is sponsored by Squarespace. Go to squarespace.com/theplainbagel to save 10% off your first purchase of a website or domain using code theplainbagel. If I were to ask you about stock trading, this would probably be the image that comes to mind. The New York Stock Exchange trading floor, a scene synonymous with stock investing itself. This is where traders meet in person to buy and sell stocks, finding deals for their clients and employers and yelling tickers and prices across the trading floor. While this used to be how most trading was done, these days you can do most of the work online. And advancements in technology have even allowed everyday individuals to take up trading at home to try and make money. But despite the fact that trading involves stocks and other investments, it is often seen as a very different practice from investing, what you or I probably do when we buy or sell stocks. You see, being a trader, whether professionally or as a hobby, is different from being an investor. And while you've probably heard of people making quite a bit of money off trading, it's an area that most people are best served avoiding. Why? We'll answer that question and more on today's Plain Bagel. If you look at the literal definitions of the terms investing and trading, you probably won't grasp the difference between the two. After all, investing is the act of spending money with the hope of generating some larger benefit or return in the future, while trading is the act of buying or selling investments. It's not very clear how the two differ. And in fact, there is no technical distinction dictating what counts as trading and what counts as investing. But the terms are often used to refer to two very different approaches to making money from investments. An investor is someone who places their money in something and looks to profit from that asset growing over time. Whereas a trader is someone who makes money in the short term by buying and selling stocks frequently. In other words, while one relies on gradual appreciation, the other focuses on market volatility.
So to go into that, I mean, he's spot on. I mean, this guy's videos are pretty much always spot on, but going into being a trader, you're usually just looking for volatility. You're looking for a market that you can get in and get out in, maybe within the same minute, 5 minutes, 10 minutes, or the same day. And then, just to kind of go over to that, you have scalpers, which are kind of like in and out, in and out, in and out. They might hold on to a trade for a few seconds to a few minutes. Then you have day traders who are going to pretty much hold a position for within the time frame of a day. So it could be a few seconds, few minutes, or a few hours, but they're usually going to get out of that same trade within the same day. And then you have swing traders. Usually swing traders are going to hold the trade for maybe like 2 days, maybe kind of going to like a week or two. And then you have position traders, which is where a majority of it's pretty much you get into that investor mind frame where you're holding trades for a few weeks to a few months. And normally that's where a lot of investors are. You're considered a trader, but you're still holding a position for a long time. And, it could be a technical reason or it could be a fundamental reason. But usually with an investor, you're usually just buying something and you just want it to appreciate over time, or you want to collect that dividend or cash flow.
Now, being a trader can mean a number of different things. Many companies actually hire traders to help them carry out their investment decisions. For example, an investment firm may decide they want to own shares of Plain Bagel Co., so they'll hire a trader to help them get the best price for the shares. In this video, however, we'll be focusing on traders who operate with the sole objective of making themselves money. And there are two main areas wherein this practice differs from investing: the timing of trades and the analysis of stocks. For timing, as we mentioned, investing is typically a long-term strategy, whereas trading is more short-term. When you invest in a stock, you're betting that over time the company will grow, either by expanding its asset base or its profits. You can invest in a company for as little time as you want, but generally speaking, you'll be aiming to sell the stock 2, 5, 10, even 30 years from now. On a day-to-day basis, the price of a stock may fluctuate, and indeed, some investors try to take advantage of that by buying when the stock's price is abnormally low. But once the purchase is made, the focus tends to shift to the long-term movement rather than the short-term volatility. Trading, on the other hand, is the fast and furious approach. It involves buying and selling investments to take advantage of short-term price swings.
And to kind of go into this as well, with investing, you're not going to really be on a smaller time frame. Like, you're not going to be on a 5-minute chart or a 10-minute chart or an hour chart. Most of the time, you're going to probably be on like a daily, weekly, monthly chart. Whereas with trading, I've seen people use a tick bar chart, range bars, just regular candlesticks. But usually you might use, like, I've seen some people trade on a second chart. Shout out Taylor Frame. But I've seen, for me personally, I used to go on 2-minute charts, but man, it was just all over the place. Now, during times of high volatility, I can see myself going to those smaller time frames, like a 2-minute chart or a second chart. But for the most part, I stay on the 5-minute and above. I'm trying to get to the point to where I can just stay above a 30-minute, but sometimes I just get enticed to go down to a 5-minute.
Day trading, for example, involves individuals buying and selling stocks same day, while swing trading expands the process to a few weeks.
Oh, so if I just waited a little bit longer, he already went into what I mentioned earlier about the difference between trading. Well, he didn't go into scalping, so he didn't do that, but he went into the difference between day trading and swing trading.
Months or sometimes years. There are other styles of trading as well, but
Well, he's kind of wrong on that part. So a swing trader is not going to hold a trade for years for the most part. That's very rare for a swing trader, unless you kind of have like that kind of idea that it may. But for the most part, as a swing trader, you're going to be in and out within a few weeks. A position trader, on the other hand, is most likely going to be in trades for maybe a year or two plus.
they all tend to fall under fairly short time frames, sometimes even making buys and sells within a matter of seconds. Because of this, traders submit many more trades than investors, and often cycle through many more positions. But selling something shortly after buying it doesn't alone make you a trader. So let's move on to the second point of distinction.
Also, when you're a day trader or a swing trader and you're buying and selling pretty often, your taxes are going to be a lot higher. There are some products that are a little bit more tax efficient, but not many. Let's see, what else did he go over? Usually you're going to add up a decent amount in commissions just through your broker, especially if you're trading on margin. So you're not going to only have to pay your commission fees, but you're also going to have to pay the margin fees. Usually you can kind of negotiate with your broker on those on the margin fees and the commission fees if you have a decent sized account. But if you have a small account, usually they're not going to be willing to maneuver that much with you.
The analysis. To understand how the analysis of a company and its stock price varies between traders and investors, we first need to explain the difference between a stock's price and its intrinsic value. Theoretically, the price of a stock only reflects the number of buyers and sellers trading that stock at that given point in time. And past this stock price, there is some intrinsic value, a true worth of that stock that only an omniscient being would know. Over time, the price of the stock should track closely to this intrinsic value as buys and sells factor in company information known by the investors. But human factors like fear or greed might lead a stock's price to deviate from its actual worth from time to time. Within the world of investing, people take two approaches to this information. Passive investors ignore short-term fluctuations in stock prices and look only to benefit from the rising intrinsic value, knowing that even if they do buy an overpriced stock, they should benefit in the long term as the aggregate market grows. Active investors instead try to estimate a stock's intrinsic value so that they can buy the stock for less than it's worth, allowing them.
So I'm not certain if he's just talking about active investors or active traders, but a trader, at least from my point of view, I'm going to mostly look at trends. And also, I look at intrinsic value as well. But let's see what he's talking about when he talks about active investors first, and I'll go back over it if he doesn't explain it.
Allowing them to benefit not only from the rise in intrinsic value, but also from the return of the price to its intrinsic level. While these two approaches vary from one another, they both generally depend on the intrinsic value of a stock increasing. Traders, on the other hand, only care about the stock's price. There is no attempt to estimate the intrinsic value of their stocks. And indeed, many traders buy and sell stocks without even knowing what the company does.
Yeah, no. So just because there's a difference between an investor and a trader, but even as a trader, you still want to have the idea of what the intrinsic value is, because that still gives you an edge. So trading is all about an edge. You have to have an edge to become profitable. So that being said, you still want to know the intrinsic value. Now, it kind of comes down to, what do you believe the intrinsic value is? And what does the market believe the intrinsic value is? And there could be a lot of reasons on why your interpretation on the intrinsic value is going to be different. Now, it could be because, now this is for me, it could be because the Fed is deciding to raise interest rates. So usually when that happens, you're going to see a lot of capital be pulled out of markets and go to cash, or go to, dividend stocks or defensive stocks and stuff like that. And you won't see high growth, high beta stocks rise in value as much. But then once the Fed, usually in the US, the Fed is on the Keynesian economic model. So usually you're going to see the US Fed, wanting to keep rates super low. Like, we haven't had crazy high interest rates since the 70s or 80s, when inflation was going crazy. So anyways, there could be a lot of different reasons on why a trader and an investor might have the same idea on what the intrinsic value are. I don't really think that there's a huge difference between a trader's view on intrinsic value and an investor's view on intrinsic value. Usually a trader will get in a little bit before an investor, because you are also using technical analysis. Whereas an investor might just say, I like the price and I believe the intrinsic value is $20, even though we're currently at $10. So then you're going to try and get that spread between the $10 and $20 price in the stock. So, but as a trader, for me, I'm not going to try and catch a falling knife, is what we would say. I'm not going to try and catch the falling knife. I'm going to wait for, I might have that same view on intrinsic value, but what I'll do is I'll say, hey, look, I'm going to wait to see that there are other buyers coming into the market and I can catch some momentum to lead to that intrinsic value. So I'm a little bit more capital efficient, rather than just buying and holding an equity that can continue to drop in price and I still have that capital sitting there. And if it's not collecting a dividend, then I just have the capital. To me, is just at waste at that point. So it kind of comes down to where you have to understand the fundamentals, you have to understand the technicals, and when you combine both of them, you can get a lot more confluence and conviction on why you want to place that trade to lead to the intrinsic value or the true value of that equity. But anyways, we'll jump back into the video and see what else he has to say. Oh, and just to go, he's more of a passive investor. I think he's like a CFA. He works for, I think it's like a hedge fund or a money manager or something like that in Ottawa. But my opinion is going to be different than his, because I trade global macro. So I'm doing I'm trading a lot of different products, and then I'm putting that capital into more passive income. So I'm taking leveraged assets, taking a profit from that, and then putting it into, I wouldn't say safer assets, but a little bit more passive investing. So I'm not saying that he's wrong. I'm just coming at it with a different opinion from my point of view.
Looking only to take advantage of the short-term swings or trends in its stock price. For this reason, it's common for traders to focus their analysis on technical indicators. These are...
So he's right. So if I would have waited just a little bit longer, yeah, we do use technical indicators. Well, not all everybody, but I would say technical analysis. So we're usually going to look at charts, and we're going to mix the fundamentals with the charts to trying to figure out when those buyers are coming back into the market. And yeah, so that's pretty much it. Let's see what else he has to say.
There are measures and gauges that only take into account historical pricing information to help the trader determine whether there's a developing trend or pattern that they can quickly exploit. It's the graphs and charts you imagine when you think of a professional trader sitting in front of their 4 screens buying and selling stocks. Now, some traders do incorporate qualitative information into their research as well, but it is usually only to take advantage of a short-term shift that they're expecting in the stock's price. For example, if a trader finds out that a company is announcing news tomorrow, they may decide to buy the stock with the belief that the company's announcement will be positive, leading to a jump in the stock's price. In either case, traders generally only focus.
So that is true. A lot of trading and investing is pretty much just information. Like, how much information are you able to get, and how fastly are you able to act on that information? And then also finding a technical way to get into that trade. Now, some people will just buy, they just have that feeling and they won't even care about the technicals. But for majority of the time, you're still going to want to have the technicals, even if it's on a smaller time frame and you're just looking for like a moving average cross or something like that. You're still going to want to use some type of technical analysis to find your entry. That way you can have a decent entry and a decent stop on that position.
Focus on snippets of a company's information rather than trying to develop a broader understanding of the firm's operations. So those are the 2 primary ways trading differs from.
So he is right on that. Like, usually if you're trading and you're not investing now, and I can't say that 100% because I do know some investors who don't technically trade, but they'll have like a little bit of like, you hear something like, let's just say in 2020, for example, EV companies were just skyrocketing, like Tesla or Lucid, what's the other, Neo. You might be an investor, but you're just saying, hey, like, these things are the future. And I also have momentum going to the upside, and I see all the news coming out that's good about EVs and, the Eurozone going, I think, completely electric in 2035 or 2045, something like that. So you could be an investor and also take part in some trading activities. So they will mesh together every once in a while. But as a trader, usually you're going to take that quick information and you're not going to buy and hold. You're going to probably get in and get out, try and get that quick little like pop. So, it might go from 50 to 52 that day, and it could go to 53, 56, 60 the next day. But you're just trying to get that little pop, get your money, get out.
From investing. It requires a very different mindset and operates in a very fast-paced, competitive environment. Some would even argue that it requires a fair amount of bluffing. This was more so the case when traders used to talk in person about the stocks they wanted to buy and sell. But even today, traders often try to hide their true intentions when they submit an order. After all, if you can convince other traders that you don't want to buy something, maybe it'll...
So this, for the most part, isn't going to, really correlate with people, at least in the beginning. You don't really have to tell anybody, oh, I'm not trading this or I'm trading that. Usually you're going to come into this issue when you're trying to trade size. So let's say you want to put on like a $50 million position on like Apple or something like that. You don't want to move the price of Apple outside of that range where you want to buy. So usually you might try and, finagle your way, or have to deal with multiple brokers to get that position filled. Whereas like if you're just trying to buy like, you know, 100 shares of Apple, you don't really have to try and like tell somebody, oh no, I'm not buying Apple, or try and, you know, do some type of synthetic long, or like sell a put option, a cash secured put option, or try and buy some calls and then also buy some shares of stock. You know, that's only going to come when you're trying to trade a decent, like I'm talking about like millions upon millions of dollars. So that's when you kind of have to get a little like creative, and you have to have like size, let's see, you have to have ranges on prices where you're willing to buy and like, you know, accumulate those orders to get long. But for the most part, you don't have to do that, like on a lot of people's levels, unless you're trading like hundreds of millions of dollars, you're not gonna have to worry about that.
To get it for a lower price, just like with anything else. All of this can make trading a very alluring practice for young investors. I mean, competition, fast trades, quick payoffs, it's got it all. And with all the ads that we see online of millionaires in their private jets explaining how they went from zero to hero with their $300 trading strategy, it probably seems like a fairly easy field to enter. But trading is a high risk practice. Most traders put a lot of money behind their individual trades, sometimes even borrowing to leverage their returns, which exposes them quite heavily to short-term.
So that kind of goes into what I was speaking about earlier when you're trading leverage assets, or trading on margin. So I trade forex futures and options. Those are all leverage positions. When I'm doing anything stock wise, I like to just do a cash, like no leverage at all. I wouldn't even do a 2-to-1 leverage. I just straight cash when it comes to like equities. But when I am trading leverage assets, that's what I'm saying. You have to be a little bit more, and I would say you have to be a little bit more cautious and a little bit more like procedural. So you have to say, okay, I have my stop and I have my target, and you're sticking to that. You're not trying to like, oh, I'm going to move my stop down so I don't get stopped out. No, you can't. Well, you can do it, but you don't want to do it. You're always going to end up taking a bigger loss. It just takes that one time where you move your stop and it goes in your favor, and then you're like, okay, I can start moving my stop. And then the next thing you know, you buy a high and it just keeps tanking lower and lower, and then you blow your account. So anyways, when you're a trader, you are using a lot of leverage, and that's how you're able to really make a lot of money quickly. But then when you're trading stocks, and you're just more of a passive investor, usually you're going to grow money a lot slower, but it's usually going to be a lot more consistent, and you're not going to be stressed out. You're not really going to have to pay attention too much to news. Maybe if there's like some management change or like some accounting fraud or something like that, you might have to kind of look into you know, rearranging your positions and stuff like that with a stock. But for the most part, you know, buy and hold. You know, we've had like the last 12 years, is it 12 or 13? Like the last 12 or 13 years, we've had super low interest rates. So everything for the most part has gone up. If you haven't gone up in the last 10 or 12 years, you just have horrible management. It's either horrible management, or the market just does not like your earnings, or the person who's running the company is not efficient and they want somebody else in there. But anyways, let's jump back into the video.
Volatility of individual positions. It also requires a lot of effort and time. Many trades only end up yielding a fraction of a percentage point, meaning traders are continually rolling their money into new positions. And honestly, when it comes to amateur traders, the truth is there just isn't that much working in your favor. With such,
I would agree with them on that. Like, you always need to find markets that are volatile. If you're trying to trade a market that's not volatile, usually it's just going to be sideways, and you're just going to get caught in the chop. Like, you're going to get stopped, stop out, stop out, stop out. And then usually when you have that volatility, you're going to have some decent trends that come with that volatility.
such a narrow time frame, you're often forced to make decisions on fragmented information. And when you consider that you're competing with industry professionals with copious amounts of money, cutting-edge research, and even industry best algorithms that can trade fast.
Okay, so I kind of disagree with him on this. Anybody can find an edge. You don't have to be some, rocket scientist like quantum physics genius to make money trading. You just have to have an edge. Like, you have to find an edge on market structure or trends. And even with the research, like, you could get decent research for a couple $100 a month. or maybe even a couple $100 a year. Like you don't have to have like some crazy amount of research. You just have to have somebody who can kind of point you in the right direction on where the market's going to go. If something's overbought, oversold, or what's going on economic wise, that could help give you a little bit more of an edge, and then you add your technicals to it. But I think he's kind of coming at more of a biased perspective in this video, since he's more of a passive investor. And since I'm both, I'm trying to, keep, give you guys a decent amount of information on both. And I'm not saying that he's wrong, but in this instance, he is wrong. So he's, he's making it seem a little bit harder than it actually is.
Faster than you can say the word stock, it's just not a fair fight. Now, I'm not saying you can't make money trading. There are people who make a full-time living from their home with trading activities. And some companies even offer salaried positions for traders, like we mentioned earlier. So there are some merits to the field. But trading is a lot like playing poker. You can be very good at it, and indeed some people do make a living from it. But there's a lot of chance involved. And with other great players at your table, the odds are often not in your favor. So any advisor will probably...
I would agree with him on that. It is hard. It's harder than most things. You do have to have some type of idea on when you, I forgot what the term is, but it's like if you're sitting at the poker table, if you can't figure out who the fool is, then it's you. But so when you kind of use that in trading, and I wouldn't even say it's gambling with trading, like when you have an edge. Like if you have two aces and you have an ace on the table, then you have a high probability of winning. So you kind of know when you need to place a bet or you need to place a trade, and because you're not going to make any money if you don't risk any money. So you kind of have to find that balance. But you do have to take into consideration the probabilities of things. So that's why you don't go all in on one trade. Like you have to diversify your trades. And I wouldn't even say you diversify your portfolio, because you're not long-term investing, but you're just diversifying your trades. So I might trade, if I'm bearish on the yen, then I might trade the CAD yen long, the euro yen long, the dollar yen long, the Swiss yen long, the pound yen long, and I might get stopped out on 2 of those trades, but the other 3 I made money on. And then if my risk reward ratios are right, then I'll still make money being bearish to yen, but I might have got, maybe, let's just say maybe the pound decided to raise interest rates. I'm trying to follow up, man. Maybe the pound decided to do something interest rate wise, or maybe something with Brexit happened. And then all of a sudden, it just messes up my pound yen position. And then people really go to the yen instead of the pound. So I get stopped out on that trade. But maybe my CAD yen trade, maybe oil and CAD are heavily correlated. So maybe something with oil goes off and my CAD yen position just makes me 3 times what I lost on the pound yen. So you have to take into consideration the risk management and diversification of your trades. So I wouldn't say go all in on one trade. I would say risk like 0.25 to maybe 2% when you're trading a leveraged asset, like Forex or futures, and even options. I would just say, spread your wings out there as wide as you can and try and grab as much profit as you can. And don't just try and go all in on 1 or 2 investments. Like with stocks, if you really have some faith in the company and you're not trading with leverage, you can go a little heavy on those positions. You could go 5, 10, 15, 20% of your capital allocation towards that stock. Because usually, even if it drops 50%, you're still taking a heavy loss, but normally it's going to rebound if it's a solid company.
Probably tell you that investing is the better way to go for the average person. By carrying out more comprehensive research,
I agree,
and holding over the long term, you're more likely to benefit from the broad growth of the economy and the stock market as a whole. Sure, you won't get that same rush as a tripled levered buy on an out of the money put option, but that's probably for the best. After all, if you're looking for
Nobody is going to try and go heavy on an out of the money put option. Everybody is trying to go heavy on out of the money call options. And you want those things to print. You want to YOLO those things. Where's Lambo? Anyways, investing is a lot easier than trading. And I definitely feel like investing is more probable for people to make money in the long run than trading. Trading takes a lot of time. It takes a lot of effort. You do need to put some research into what you're doing, a lot of research actually, and it has to just be something you're naturally love, like something that you're passionate about. Whereas investing, I think everybody should be investing. Everybody should be buying some stock or some cryptos or a bond. If rates go up, then start doing bonds. But for now, crypto and businesses, stocks, everybody should be investing. Real estate, everybody should be investing something for the long term. But trading, it's not for everybody.
For the rush of high stakes and not so great odds, you may as well go to the casino. At least there you'll get free drinks. Thanks for watching. If you like this video, make sure to hit the like button. If you like what we're doing here, make sure to subscribe. Hit the bell icon if you want notifications about future videos. If you have any feedback or topics you want me to cover in a future video, leave a comment down below. For The Plain Bagel, my name is Richard Coffin. Thanks for joining me today. So perhaps your trading venture isn't going to bring you the success and fortune you were hoping for, but maybe you have your own business you're trying to gain traction with. Or maybe you're looking to get your name or your work out there for people to discover. While there's no surefire way to achieve success, there's no denying that having a website can help you with whatever you're working on. And today's sponsor...
Oh, okay, so that's something with Squarespace. But anyways, it's a good video. Hope you guys enjoyed the commentary on it. Hopefully I can help you guys, with your knowledge on trading and investing. And please like, comment, subscribe, turn on the post notification bell, and I'll see you guys soon. Peace.
Man, even Jesus had a shooter, and God be having unbelievers that didn't mess up their demeanor. And yes, they know it's hard, they know, cause when they be up in those trenches, man, they show out. But what they do